Hello, everyone. So we are here with the Indian banking industry. So this is our team. Can you move next? So this is our agenda. We will go through the industry overview, the Porter five forces, the best analysis, the value chain, the key success factors, and the three companies that we have taken are SBI, HDFC, and JP Morgan. Next. So we'll go through the introduction. So the Indian banking industry has been on an upward trajectory aided by strong economic growth, rising disposable incomes, increasing consumerism, and easier access to credit. As of March 22, 2024, the bank credit stood at around rupees 164.34 lakh crores. Next, please. The public sector banks accounted for over 57.48% of interest income in 2023. The interest income of public banks reached US $102.4 billion in 2023. And in 2023, the interest income in the private banking sector reached US $70 billion. India is one of the fastest growing fintech markets in the world. There are currently more than 2,000 fintech businesses in India, and this number is rapidly increasing. Next. So I will go through now the Porter's five forces. Next. First is the threat of new entrants. So as of 2023, the Reserve Bank of India requires a minimum paid-up capital of 500 crores for new banking licenses. The Reserve Bank of India has stringent regulations with only 11 new bank licenses granted between 2013 and 2021. Next. Next is the bargaining power of suppliers. So the average fixed deposit interest rate among Indian banks ranges from 3% to 7% as of 2023. The bank's investment in technology has been growing, with leading Indian banks like HDFC Bank and ICICI Bank spending around 4,000 crores annually. Next. So now we have the bargaining power of buyers. So a survey indicated that 60% of retail borrowers are willing to switch banks for better interest rates or services, highlighting a moderate level of buyer power. Next. Now we have the threat of new substitutes. So NBFCs held a market share of approximately 19% of the total credit extended by financial institutions in India as of 2023. The growth of payment apps and peer-to-peer lending platforms has increased the threat of substitutes. For instance, the digital payment market in India is expected to reach around $1 trillion by 2025. Next. Now we have rivalry among existing competition. So India has over 12 public sector banks and 21 private sector banks, 44 foreign banks. The top five banks in India are SBI, HDFC, ICICI Bank, Punjab National Bank, and Bank of Baroda. And these together control over 70% of the market share in terms of assets. So now, can we move next? Yeah. So now Harshit will take over.
Hi, I'm Harshit, and I'll do the industry analysis using PESTEL framework. First is political factors. Government policies and regulations. The Indian banking industry is heavily regulated by the Reserve Bank of India. The government's emphasis on financial inclusion through schemes like Pradhan Mantri Jan Dhan Yojana led to the opening of 523 million bank accounts amounting to rupees 2,28,057 crores banked till May 2024. Political stability. India has maintained a stable political environment which is conducive to the banking sector's growth. The Global Political Risk Index ranks India at 3.5 out of 10, indicating moderate political risk. Next is economic factors. India's GDP growth rate was around 7.2% in FY 2023, which positively impacts the banking sector by increasing credit demand. In 2023, the average inflation rate in India was 5.9%, leading to changes in the RBI's repo rates, which were adjusted to 6.5% to curb the inflationary pressures. The Indian banking sector has seen an influx of FDI, with FDI inflows in the banking sector amounting to USD 1.6 billion in FY 2023. Next is social factors. India has a young population with a median age of 28.4 years, contributing to the increased demand for digital banking services. The rural population's inclusion in the banking system is a priority, with around 65% of India's population residing in rural areas, influencing the banking sector's expansion strategies. Next is technological factors. India has witnessed a massive shift towards digital banking. The number of UPI transactions surged to over 15 million till August 2024. The total transaction value for August was 20.61 lakh crores, reflecting a growth trend towards digital payments. The rise of fintech has led to increased competition with over 2,100 fintech startups in India as of 2024. Next is environmental factors. Indian banks are increasingly focusing on sustainable practices. The SBI launched green bonds worth USD 650 million in 2023 to support environmentally friendly projects. The banking sector is affected by environmental regulations and the need to finance green projects. For instance, the RBI has issued guidelines for banks to integrate environmental and social risk into their lending decisions. Last is legal factors. Indian banks must comply with various legal and regulatory frameworks, including the RBI's Basel III norms, which require banks to maintain a minimum capital adequacy ratio of 11.5% by 2024. The Indian government's push for anti-money laundering regulations has resulted in stricter KYC, know your customer norms, impacting operational processes. Legal challenges such as those related to customer disputes of non-performing assets are significant. In 2023, the total value of banking related litigation cases stood at around 3.6 trillion Indian rupees. Now, Vaibhav will come to explain the HDFC Bank.
My name is Vaibhav, and now we'll do the company analysis starting with HDFC Bank. So, HDFC Bank was established in 1994, and it has become India's largest private sector banks. And now the following report will delve into the various facets that have propelled the HDFC Bank into its current stature, supported by financial data and comparative analysis. Next slide. Now we have been seeing that HDFC Bank has been growing at a massive rate of 20% year on year. This is not only on the basis of net income, but also with respect to the net interest income, which is the major chunk of how banks earn. Next slide. Now we'll discuss how did HDFC Bank achieve this big achievement. So HDFC Bank did all three uh, strategic implementations, which was through vertical integration, in which it did expanding financial services, which was beyond going through the traditional banking. HDFC offers insurance, AMC, and then going through the technology and infrastructure, investing in its IT infrastructure to streamline operations, enhance customer experience, and support digital banking services. Then HDFC has also a large branch network expansion in which it has ATMs across all over India. Then we'll move forward to horizontal integration, in which there were many mergers and acquisition in which HDFC was acquiring small finance banks, and notable acquisitions include Suryodaya Small Finance Bank and others. Diversifying product portfolio, offering a wide range of products and retail banking and corporate banking, and geographical expansion in which it was expanding operations beyond the major cities to Tier 2 and Tier 3 cities. Now differentiation strategy in which it was adopting customer centric approach, which was prioritizing customer satisfaction by offering personalized banking solutions. And it had a small brand reputation, building trust throughout consistent performance, transparency, and reliability. And comprehensive product range. It has a wide range of financial products tailored to diverse customer needs, from basic saving accounts to sophisticated investment solutions. Next slide. Now it is a consolidation of segments. So synergy creation, combining similar operations to enhance efficiency, reduce cost, and improve service delivery. Integrated services, offering seamless banking experience by integrating services like retail banking and wealth management. Operational efficiency, streamlining process to eliminate redundancy and optimize resource utilization. Enhance customer experience, providing a unified platform where customers can access multiple financial services without need to engage in separate entities. Next slide. Now the main factor, which is for the future of banking, we can see that HDFC's revenue has almost doubled by growing 88.8% year on year. But we can see that there has been strong decline in margins, which is the main income of banks, which will remain the major issue in the coming future. At last, HDFC Bank's ascent to becoming India's largest bank is a testament to its strategic foresight, effective integration, and unwavering commitment to its customer satisfaction. Now we have Sanvi to explain JP Morgan.
So, as a part of the company analysis, we will now look JP Morgan Chase. JP Morgan Chase is one of the leading players in global financial services, offering a comprehensive range of banking, investment, and asset management services. The firm operates in over 100 countries, delivering solutions to corporations, governments, and individuals. Now let's look at its market position. JP Morgan Chase consistently ranks as one of the largest financial institutions in the world. When we look at key indicators like assets, market capitalization, and profitability, JP Morgan is at the top of the industry. What sets JP Morgan apart is its strong brand, its extensive global network, and its diversified service offerings. This combination allows the company to manage risk effectively and seize opportunities across different markets. Whether it's corporate banking, investment services, or wealth management, JP Morgan has built a platform to serve a wide range of clients. Next slide. Now let us see JP Morgan Chase annual net income history and growth rate from 2010 to 2024. Net income can be defined as company's net profit or loss after all revenues, income items, and expenses have been accounted for. JP Morgan Chase net income for the quarter ending June 30, 2024 was $17.718 billion, a 26.46% increase year over year. Now we will look at JP Morgan's PE ratio. Its PE ratio as of September 11, 2024 is 11.86. Let's look at current and historical return on equity values for JP Morgan Chase over the last 10 years. It is 15.1. Next slide. The company's financial performance has shown consistent growth from 2005 to 2023, with net income rising from $8.5 billion to $49.6 billion. Major declines occurred during the 2008 financial crisis, where net income dropped to $5.6 billion, and the 2020 pandemic, when it fell to $29.1 billion. However, rapid recoveries followed both events, with 2021 marking a high at $48.3 billion. Diluted earnings per share mirrored this growth, increasing from $2.35 in 2005 to $16.23 in 2023. Return on tangible common equity saw fluctuations with a high of 24% in 2006, a dip to 6% in 2008, and recovery to 21% in 2023. Adjustments for reserve releases bills due to the pandemic highlight the company's robust management through economic shocks. EPS and ROTCE reflect strong shareholder returns, while the company's resilience through major economic disruptions underscores its financial stability and adaptability. Now, Sanvi will take over.
Hi, my name is Sanvi, and we'll go through the slide of strategic implementation. Here, JP Morgan has strengthened its capabilities by acquiring fintech firms, expanding into the in-house wealth management, engaging in proprietary trading, and even developing its own blockchain technology. Next, about the horizontal integration, JP Morgan has expanded its market share through significant acquisitions, including Bear Stearns and Washington Mutuals, which allowed them to increase their competitive footprint in the financial sector. Finally, the strategy adopted by JP Morgan Chase is the product differentiation strategy, offering a broad range of financial services that cater to different client segments, everything from personal banking to corporate finance. This allows the firm to remain competitive by tailoring services to meet the specific needs of the diverse customers. About the consolidation of segments, at first, investment banking and commercial banking, JP Morgan's JP Morgan combines investment banking and commercial banking under one entity. It surged 50% year over year and 17% quarter over quarter. Second is wealth management. The firm integrates wealth management with asset management. And about the retail and corporate banking, through consolidation, it offers both retail and corporate banking services. Next is global markets. Global markets. JP Morgan consolidates global markets trading with security custody and servicing, and it also focuses on future performance. Despite the potential challenges such as deposit margin compression, JP Morgan remains focused on disciplined execution and capital deployment strategies. Their ability to strategically navigate headwinds position them to maintain their leadership in the financial industry. Last is value chain analysis that we have done of JP Morgan. The total revenue that JP Morgan Chase has of 2024 is $150 billion and the net income is $45 billion. The operational expenses, including significant investments, amount towards $80 billion and the diversified operations for second quarter 2024 amounts to $37.5 billion. The technology and compliance investments amounts to $3.9 billion, and it is a customer-focused company, and its investments in marketing and strategies and customer service improvements amounts towards $2.2 billion.
Moving forward, we'll be discussing the State Bank of India, its performance, and strategic initiatives. Founded in 1955, SBI is India's largest public sector bank by assets, deposit, branches, and customers. As a government institution, SBI plays a crucial role in India's financial system. SBI offers a wide range of services, including retail, corporate, and international banking. The bank's extensive network, strong governance, and focus on digital transformation have maintained its leadership in the Indian banking sector. Now, let's look at some key performance indicators over the past 2 decades. Return on equity and return on assets. Return on equity increased from 18.19 in 2004 to 20.32 in 2024. This improvement indicates profitability in utilizing shareholders' equity over time. Looking at return on investments, we see an increase from 0.94 in 2004 to 1.04 in 2024. This reflects improved profitability and asset utilization, likely driven by better risk management and operational efficiencies. Net interest margin and net interest income and net profit. Net interest margin for the whole bank rose from 3.04% in 2004 to 3.28% in 2024. This suggests SBI's improved efficiency in earning income from interest-bearing assets. Net income saw a remarkable surge from 11,186 crores in 2004 to 1,59,876 crores in 2024. Net profit. SBI's net profit skyrocketed from 3,681 crores in 2004 to 61,077 crores in 2024. Moving on to strategic implementation, SBI has employed several strategies to achieve and maintain its market leadership. Vertical integration, enhanced digital banking services and IT infrastructure, expanded branch and ATM network for wider accessibilities. Horizontal integration, strategic mergers and acquisition, including associate banks and Bharatiya Mahila Bank, increased geographical presence and market consolidation. Differentiation strategies, customer-centric approaches like YONO, digital platform, innovative products, and a wide portfolio of banking services. Heading on to consolidation of segments, SBI is focused on several key areas to strengthen its market position. Digital transformation, YONO app integrating banking and investment and e-commerce, rural banking expansion, partnerships and business correspondent models for rural outreach, public sector synergies, leveraging initiatives like Jan Dhan Yojana for financial inclusion, cross-selling, offering of insurance, mutual funds, and loans through various channels, sustainable banking, promoting green banking through EV financing and renewable energy. These strategic initiatives and focus areas have positioned SBI for continued growth success in the evolving banking landscape.